Thank you very much for joining us today on this webinar. With me, I have two distinguished colleagues, Alvin Arogo, Economist, First Vice President and Head of the Research Division, and Jennifer, Senior Vice President and Head of Marketing, where she will be explaining a little bit about the Philippine National Bank, all the marketing activities, and all the things that they're doing in the bank. And then we'll switch to Alvin, who will be taking over and discussing a hot topic that we have seen in the past few days after Trump announced on April the 2nd the potential impact of US tariffs on the Philippines GDP growth. So I'll switch and give you the floor to you, Jennifer. Thanks.
So good day to all of the members of Asian Bankers Association present in this webinar today. It's great to meet all of you. As David said, I'm Jennifer Nang, the head of marketing group for the Philippine National Bank. I'm actually here today with my colleague, Mr. Alvin Arogo, who in a short while will give you a snapshot of what to expect for the rest of the year in terms of macroeconomic outlook. I'm pretty sure with everything and all the recent developments, both here and abroad, these are the things that have been, everyone has been very concerned about. But before we go into that, let me give you a preview of who we are as an institution and how serious we are with our mission to promote financial prosperity for all Filipinos, both here, locally, and all over the world. We are one with the Bangko Sentral of the Philippines in a collaborated effort to empower the Filipino citizens to build a competitive, inclusive, and sustainable economy. Let me start at the very beginning. So the Philippine National Bank was established in 1916 with the aim of maintaining the gold exchange standard. To support this, currency reserves were created. However, these reserves, which came from our office in New York, which we still do have, it was transferred to our Manila office. And these funding were used to provide loans and financial assistance to agricultural companies for export. In fact, at that time, we were called the de facto central bank. We provided financial services to, at that time, the thriving agricultural sector of the Philippines. We were there to support the government's economic developmental efforts, which made PNB the first universal bank and the bank that Filipinos can finally call their own. Today, we are one of the largest privately owned universal bank in the Philippines. Backed by all these years of experience and customer service, PNB weathered storms and yet remained to be one of the most stable banks in the country. Our promise actually remains true. We will continue to support all Filipinos here and abroad with products and services catered specifically for their needs. One of the markets that PNB dominates would be our overseas Filipinos, global Filipinos, as we fondly call them. They include migrant workers, immigrants that have actually transferred residence from the Philippines to outside, or even students who's aiming to get their degrees outside. We have been in the forefront of providing assistance and services to them. Not only have we provided a safe and secure way for them to remit funds needed to and from the Philippines, we have products like Own a Philippine Home Loan that helps and aids fellow countrymen secure the need to have a house they can call their own for their families here or when eventually they would come back home to the Philippines. Only PNB has the largest number of overseas offices, with presence across Asia, Europe, the Middle East, North America, and over 70 representative offices and remittance centers, and maintains correspondent relationship with more than 300 banks and financial institutions and over 90 overseas agents and tie-ups worldwide. We also boast of being the only local bank in the Philippines with the widest branch footprints in the country. We have branches in areas no other banks are. We call them missionary sites or missionary branches, while others only open branches on areas that will yield the maximum profit. We took into consideration the needs of our countrymen that have no or limited access to financial institution and actually brought the bank to them. And for these areas, we have crafted a particular product that can service them. We have what we call the PNB's debit account line, a product that provides access to less served individuals and give them access to formal financial products. This account has a more liberalized customer onboarding process with simplified know your customer steps. Again, this account is offered with the objective to allow the financially unserved or underserved to receive, make payments, store of value facility. This would promote accessibility and convenience at very reasonable and non-intimidating setting. So over the years, we have made sure to adapt to the changing economic, social, and technology landscape. We boast of an app that provided digital access to clients' accounts and even a very, very robust website where both users and non-users alike can apply for financing and start their financial journey with us. We also renewed in the past few years our thrust to take a closer look and work more closely with the country's MSMEs, so the micro, small, and medium-sized enterprises. We made sure that our credit stance and product offers are very customizable to address the very unique needs of this particular segment. We acknowledge the stance of our central bank in recognizing that these MSMEs are considered the backbone of the Philippine economy, accounting for a significant portion of business establishment, employment, and gross value added. Actually, in the past 4 years, these MSMEs accounted for 99.6% of business establishment, 36% of gross value added, and 65% of the country's total employment. So we know for a fact that MSME plays a crucial role in job creation and poverty reduction. We were very close partners with BSP and also certain local governments in promoting digitalization as a tool for financial inclusion, and has implemented programs like what we fondly call the Palenque QRPH Plus to facilitate digital payments to our MSMEs. And this cuts across not only business owners, but even market vendors, really the small-time traders. We opened up the possibility for acceptance of digital payments on the front end. The BSP promotes a risk-based lending approach instead of the conventional bank assessment requiring adequate collateral, which we know can be a challenge for MSMEs to provide. These are only a few of the projects PNB is very serious about so that we can help the government further the cost to help the SMEs of the country. Therefore, in 2024 and beyond, we are poised to move forward to become an even more customer-centric, flexible, results-driven, and innovative bank. Ranking as the best bank in the Philippines in Forbes' list of the world's best bank last year, PNB was also named the most admired financial services provider by the International Business Magazine Award, also in the same year, 2024. I was talking about our digital app a while ago, and we were actually awarded by Digital Customer Experience Awards, Excellence in Customer Service Innovation under the Strategy Award category. And to be proven by Alvin in a few minutes, the best bank for investment research in the Philippines during our Euromoney's Private Banking Awards was also won by the team of Alvin. All these achievements are backed by our drive to convey a strong message of reliability, resilience, and progress through our multi-awarded campaign, Every Step Together, which actually communicates PNB's commitment to support its customer in their life's journey. Through Every Step Together, we assure our customers and stakeholders that PNB will always be the bank they can depend on in every stage of their life, whether they are here or wherever they are in the world. These three powerful words will always be PNB's anchor to reach milestones, conquer challenges, and celebrate success with every Filipino. Whatever challenge the future would bring, Every Step Together shall constantly inspire us as a bank and as an individual to always be dynamic, innovative, and customer-focused, a dependable financial partner that offers stability and security for Filipinos all over the world. Give the floor to our economist and head of research, Mr. Alvin Arogo, for his 2025 macroeconomic outlook.
Thank you, of course, to the ABA for hosting this very timely economic briefing for its members. Let me talk about, my preliminary analysis of how the U.S. tariffs will affect the Philippines, with a particular focus on our economic growth potential, or the GDP growth. As many of you may appreciate, things are very fluid at the moment, but I have done some preliminary scenario analysis, and I'd like to share some of those in this afternoon. But before I go there, I lay out first what are my current baseline projections. And with the exception of inflation, most of these have not yet considered the recent developments with regards to the tariff. So for the economic growth, I was looking at a recovery to 6.2% expansion rate in 2025, coming from a decent but below government target growth rate of 5.7% in 2024. I have actually factored in some of the tariff war that we are seeing right now, but what I assumed then was much of the tariffs would just be a negotiating tool and not as big as it was, as we have seen during the Liberation Day announcement last week, then followed by the escalation, particularly between China and the US. But for the 6.2% economic growth that I was looking at for this year, I have baked in a 2% decline in goods exports for 2025. And that's already, that seems mild now, but that's below our run rate of, our base rate of about 4.5%. But later, we'll discuss how this 6.2% growth might be harder to achieve given what's happening right now. But putting that aside for a minute, what's really going to help the Philippines economy to grow this year would be the resumption in household consumption, particularly food and non-alcoholic beverages. See, in 2023 up to the first half of 2024, the Philippines, being a country that loves rice, was hit the most by El Nino and its subsequent impact on rice prices. We love rice so much that it accounts for 9% of our consumer price index, or CPI basket. As a result, we had very high inflation, coupled with all the commodity price shocks that we have seen in 2022 spilling over to 2023 of 6%. Now, for context, in the Philippines, what our central bank considers good inflation is somewhere between 2 to 4%. So clearly, the level of price growth that we have seen in 2022 at 5.8% and 6% in 2023 were not ideal. In 2024, the Philippine government lowered rice tariffs, and that helped a lot in terms of managing inflation. So we were able to achieve a better rate of 3.2%. And I believe then, as I do now, that that would be a significant tailwind for consumers in the Philippines, which as a whole contribute about 70% to our total gross domestic product. For the first quarter of the year, our inflation was actually towards the lower end of the BSP's target of 2%. And for the whole year of 2025, I'm looking at 2.5%. But for inflation, unlike GDP, my recent report was published after the tariff announcements, and I have already factored in some unintended consequences, meaning what we have learned during the pandemic was after the lockdowns, when capacities for logistics were constrained and did not grow as fast as the economic rebound that followed the reopening of most economies, shipment cost rose, and that has really impacted inflation. And although some people believe that the high tariffs imposed by the US on China may lead to more efficiently produced goods going to other countries like the Philippines, thereby lowering inflation, what I have started to price in is maybe there are some unintended consequences that we have not yet seen, particularly on how this whole trade war will impact the efficiency of global supply chains, impact the efficiency of global trading routes, and that may have an unfortunate increase in the global cost of shipping and inflation. And that's why for 2026, my inflation forecast, at least for now, is closer to the higher end of the Central Bank of the Philippines, or BSP's target of around 4%. Now, the policy rate of the Philippines is called the RRP rate, and just like most global central banks, we are currently in an easing cycle after peaking to a rate of 6.5% in 2023. That was reduced to 5.75% in 2024. During the first meeting of the BSP, the easing cycle was paused, with the governor citing global uncertainty as a reason to maybe think about when the next easing will be. However, with low inflation and downside risks to growth, when the BSP meets in less than an hour, or when the BSP announces the result of their meeting in less than an hour, I believe the policy rate easing will resume with the 25 basis points cut to 5.5%. This means that for the rest of the year, my baseline view is another 25 basis points cut. But this view will probably change depending on how things evolve. For 90 days, there's a bit of a relief because of the tariff pause, or pause on the reciprocal or individualized targeted tariffs announced a few hours ago. But definitely, the policy rate path moving forward would be a bit trickier for the Philippine Central Bank. Finally, for the foreign exchange market, driven by generally widening current account deficit, as well as the lower interest rate differential between the Philippines and the US, the peso, using the importer's perspective, has weakened from 48 during the pandemic to 57.8 as of the end of last year. Notwithstanding the current weakness of the dollar because of the trade war, it's the likelihood that we will still trade somewhere around the 58 to the 59 level is there because of the further widening of the current account deficit that we expect as exports, particularly to the US, decline. However, given the focus of the US government to recalibrate the value of the dollar, a strengthening of the peso is still on the cards. But one thing is for sure, if past 2 years was volatile for the currency, 2025 is going to definitely be more volatile. So as many of you are aware, April 2, tariffs were announced for many countries. and this was paused overnight. But basically, what I'm showing at the moment are the original tariffs, at least the one that was flashed by President Trump during his speech. And the Philippines is, for that presentation material, was 17%, but details show that individualized tariff for the Philippines is 18%. It's bad considering that before this, the weighted average tariff for Filipino goods exported to the US was around 3 to 4%. So it's a big increase. But I guess the silver lining is we are one of the lowest, only following Singapore at 10%. I believe that provides some opportunities for businesses, although it remains to be seen whether Philippines being a backdoor for goods produced from other countries will take effect right now, since that very mechanism of moving your supply chain to another country with lower tariff is the very thing that happened in the first administration of President Trump, that it seems to be what they are trying to avoid or not let happen again for this second round of the trade war. So just to give you a context, Philippines is a net importing country, but for the US, from our perspective, we have a trade surplus. So that's why that's one of the reasons, probably the reason why we were slapped with the higher than baseline tariff of 18%. So the US is a very important export destination, accounting for about 17% of our goods exports. But for imports, the US only accounts for 6%. Now, in terms of exposure, a lot of the Philippine products sent to the US are electronics. For example, office machine parts, integrated circuits, insulated wires. There are agricultural products as well, particularly coconut oil and fruit juices, for example, pineapple juice. So those are the most exposed exporters now for the Philippines, and those are the businesses that would likely need to rethink or evaluate what the strategy would be as global tariffs have been imposed. Fortunately, as I have mentioned earlier, there is, at least as of this webinar, 90-day reprieve, reducing the tariffs to the baseline amount of 10% for all countries except China. As you can imagine, it is very challenging, if not impossible, to pinpoint or to provide a particular estimate of what the trade war will do. So a good starting point is to look at the historical episodes during which the Philippines had significant contractions in its goods exports. At least starting the year 2000, there were 4 episodes, so 2001, 2009, 2020, and 2023. So 2001, that was on the back of the dot-com bubble. For 2008, that was a result of the global financial crisis. 2020, of course, is the global lockdowns. And 2023 is the overall weakness in the electronics market, as most consumers shifted from purchasing goods during the lockdown to resuming their services experiences. And what we can notice is, worst case, the Philippines had a decline of 10% year-on-year in 2009 for its historical experience of a significant drop in goods exports. It has definitely affected the Philippine economy, with the exports of goods alone accounting for about 17% of our GDP. I think what's harder to compute is how the other variables like household spending, business investments, and the government's response will be, as well as how imports will move, considering that part of what we import are inputs for exports. But what we can see is definitely once goods exports show weakness, it is a reflection of a weak global economy, and therefore our household consumption, although will not be in a recession except during the lockdowns, will definitely be affected, as well as business investment. But the good news in the Philippines is, given our big household consumption, the big contribution of household spending on overall GDP, we are somehow insulated, no, relatively, against other Asian countries that may be more reliable on exports. So for that reason, we do expect gross domestic product to grow slower, but perhaps not enter into a recession. And the only time we've seen that, at least for the past 25 years, was during the lockdowns.
Thank you, Alvin. Thank you very much for shedding some light on the recent developments in the economy. I think we all agree on the turbulent times that we're going through. As we included in the chat, please, write whatever question you may have in the Q&A box so we can take it from here. I selected one for Alvin, one from Jennifer. I'll start with you, Alvin, as you were the last one. One attendee was asking, why the policy rate, fluctuated so much from 2% to 6.5 within 2 years.
Oh, yeah. All right. Well, that's really the reduction to the 2%, which was the historical low, was a result of the pandemic. So in the US, rates were brought down to zero. For the Philippines, we cannot do that. We need to have a positive interest rate differential. Otherwise, our currency would be hit hard. So that was the low base. No? And after the pandemic, a lot of things happened. I actually don't know where to start. But what's good to highlight would be we had a commodity shock because of what happened in Europe. We also had the reopening shock, which, as we all know, the supply chains were not able to catch up with the reopening, and that has led to higher shipping costs. Then we had El Nino, and in the Philippines, it's a big deal because, as I mentioned, we love rice. It's like 9% of our CPI basket. And so all those things added to a high inflation environment in the Philippines. And the central bank, the BSP, had to act. They had to act fast. So they had to raise rates to 6.5%. So basically, you had the pandemic and then everything that happened after the pandemic, leading to an all-time or a historic low of 2%, and then raising it sharply to 6.5%. Great.
Thanks, Alvin. One for you, Jennifer. One of Tommy was asking how the PNB is collaborating with rural banks. You were mentioning that you have these missionary branches where PNB is the only one that is, serving this, particular segment. Can you explain a little bit, like how you're working, like what is this missionary, are they profitable? How is the expansion plans, if there are any?
Okay, thanks, David. Well, there was another question about how we turn around our missionary branches. Well, of course, compared to branches, the regular branches that you will see in our metropolis, it'll take a bit longer for our missionary sites to break even, so to speak. But given the increase in local government initiatives to build the businesses in these sites, while it might take a bit longer for us to turn these branches around, the horizon's always very optimistic. We've worked very closely, not with the rural banks, but with the local government and the prime movers of these missionary areas. We've been able to have a very close working and financial journey relationship with them. Again, we have our heads and hands on the ground. We hear what they need, and we try to come out with products that are very, very specific and very customizable for them. And we try to encourage all of them to go into the digital realm, because as it is, infrastructure is always a challenge. So we work very closely with the telcos, we'd work with the LGUs, even organizations that are non-government. We'd come out with, would meet with them, come out with projects, just so that we can help them take that first financial step. And PNB has always been there, and we're always the trusted financial institution on these very far-flung and, again, what we call the missionary sites. I hope that answers the question.
Yeah, thank you very much, Jennifer. I think it's a very laudable work what the bank is doing for this unanswered segment. One for you, Alvin. I think in your PNB research you estimated an inflation of 2.5. I guess given the latest news and how the market has been reacting to the tariff imposed by Donald Trump, what's gonna be your estimation? I know that that the bank, the government, it's issuing a new rate, but how volatile you think this inflation is gonna drive the market in the Philippines in the next few months?
Yeah. Well, okay. So the way inflation is computed is year on year. And so it is subject to base effects, meaning if you had a high base last year, then your year on year now would be hard. It's difficult to make it high unless you have a big shock. And the case for the Philippines is the peak of our very high rice prices happened from January to August of last year, which means we will benefit from that favorable high rice base. And given that the tariffs on rice that the Philippines imports were reduced middle of last year, and global, or at least Asian rice prices, or from where we import the most, which is Vietnam, has declined significantly. The optics of inflation for the Philippines would be very benign until August of this year. No, that's why the 2.5%, that's not forward-looking. That is it's for the year, but it's not forward-looking in the sense that a lot of that comes from the favorable base effects of how rice trended between last year and this year. No? The big concern is what happens starting the fourth quarter of this year. And there are two schools of thought. The optimistic ones are saying that because of the high tariffs imposed or threatened by the US to China, and with China being one of the most, if not the most efficient producer of mass market consumer goods, then a lot of those excesses will find their way into other countries like the Philippines, despite China already being the #1 source of imports, meaning, flooding, quote unquote, flooding other countries with cheaper goods, and that will be positive to inflation. So that's the positive or the optimistic view. The other view is the unintended consequences of this trade war. And that one is harder to predict, but we've seen a flavor of it with what happened after the economy reopened. When the economy reopened, rather, after the pandemic. And so balancing those two things, I see the Philippines inflation slightly rising above the target for the first half of next year. So that's where the risk is, whether it is the influx of cheap goods coming into other countries like the Philippines because of the US tariffs on exports from China to the US, versus the unintended consequences of this trade war on shipping costs, on commodities. No? And for now, what I see is it will be a threat to Philippine inflation during the first half of next year.
And how do you foresee the impact on the potential contraction of the economy for the banking sector in particular?
Well, we've seen this during the pandemic and other crises. The first thing that will be impacted would be non-performing loans. The good news is the Philippines has a very strong and strict regulatory body. And so after the Asian financial crisis, the Philippine banking sector has been able to weather a lot of crises, the global financial crisis, European debt crisis, the COVID lockdowns. No? So definitely, although this is unprecedented, so I don't want to say something that will not age well, but definitely the non-performing loans would be a key risk area. And of course, with slower economic growth, lending as well will be affected. But like I said, because of the strong regulatory body in the Philippines and the harsh lessons learned during the 1997 Asian financial crisis, the Philippine banking sector as a whole is very strong. And, of course, this is again unprecedented, but that gives me some comfy pillow at night when I sleep and think about this thing.
Thank you very much, Alvin. I'll switch to you, Jennifer. There was a part of your presentation you were mentioning the effort from the bank of digitalizing the services and actually getting some awards in terms of customer excellence, customer service. What are the plans for PNB? Are they trying to reduce the branches, or they're gonna be thinking of having like a dual strategy where digital services and branches will coexist for the upcoming future?
Thanks, David. Well, according to the digital transformation roadmap of the BSP, BSP actually aims to strengthen the country's digital payment system. Particularly, they want, I think, 50% of all retail transaction to go through the digital channel and to include 70% of Filipino adults into the financial landscape. But having said that, we all know that digital banking is rapidly growing, not only here, but everywhere. But the thing is, the physical branches and even the automated teller machines or the other machines that we use are very unlikely to be replaced because of digitalization. What we see and what we're doing is actually converting these physical branches, these physical infrastructure, into a more sales and service hubs, wherein everyone is more service-oriented. We try to leverage on while we leverage on technology and analytics to make the interaction both advanced and personal. So long and short of it, no, we don't see the intent to replace branches or even to lessen branches or to close branches, but it's really the evolving of how we treat these physical branches from very transactional to a more problem solving, a more personal collaboration with the market that we serve.
And given the rapid expansion of these digital channels, can you share with us some of the current initiatives, to serve these customers, to being able to put a bank on the phones, to many of the Filipinos that they start entering financial services, that they start paying the first digital payments through the app. What are the initiatives that the bank is doing, to promote this financial inclusion?
I think I touched a bit about the initiative of the local government and central bank on what we call the QRPH. So it's actually a method wherein retail payments, let's just particularly talk about the ones in the marketplace, the market vendors. We make it available for them to accept, not try to veer away from accepting cash, but accepting payments using a QR code. And we've launched into a lot of programs and a lot of campaigns, both literacy and assuring them that, because at the end of the day, people still at the back of their mind think that, is it safe? If I use a digital channels, is it safe? Is my money safe? So it's really launching into a whole program in making them, number one, understand, number two, experience, and number three, enjoy the convenience of such. So this is one of the major project. Again, this is nothing new, and this is not specific only for PNB, but this is a handshake between the government, the local government, and the Bangko Sentral ng Pilipinas to educate and to include all our less and underserved sectors of the society.
Thanks, Jennifer. I think it's very clear, the massive effort for the bank, to tackle this, big problem in the Philippines and what lies ahead. I will switch back to you, Alvin. We know that the turbulence happening given the tariffs. It's putting the dollar upside down. What are your forecasts for the next few months? Because we know there is a lot of Filipino community, and that influence of the dollar can have a direct impact on those people.
Yeah, you know what? It's the variable that's most difficult to predict at the moment, no? But definitely, I'm still leaning towards the side of the peso weakening, meaning the number will be closer to around maybe 58 and 59. And the reason for that is the clearest impact of what's happening would be a lower exports for the Philippines. And at least in the short term, I don't think imports will react as fast, meaning the decline in exports will be more than the decline in imports. So simply put, lower supply of dollars in the Philippines. And for the past 10 years, but again, we are unprecedented in terms of the global economic order. But past 10 years, the trade deficit has been able to explain around 85% of the movement in the peso dollar exchange rate. But having said that, the tricky part is we know that the US president wants to make US exports more competitive. And that means making sure that it is cheaper for other countries like the Philippines to buy goods from the US, which means the peso has to strengthen. I don't know how that will happen and at the same time reduce our exports to them. But for now, that's where I am. But definitely, I'll be very frank here, and it is very tricky, no? But what's giving me, again, confidence to what I said about maybe we will go back to 58 to 59 again is during the initial dollar weakness momentum post April 2, the peso only went to 56.8. But even before the tariff pause, it went back about 57 again, which shows you that sliding back to 56, despite this desire for the US to make it affordable to buy their goods, seems to be not holding up. But don't take my word for it, because we are entering, again, as I said, unprecedented times. And my model is only able to explain 85% of where the exchange rate or the Forex will go. That remaining 15% is still large. And that's notwithstanding the change in the economic order. So actionable advice, don't try to time it. Buy when you need the exchange rate, sell when you need. But speculating or buying, selling, at least for individuals, no, for profit and gains, this may not be the best time, given the, again, unprecedented amount of change that we are experiencing and going to experience further.
Okay, I will ask one more question. I know, Alvin, you have to run into the meeting to check the latest news. What is your view, given you were mentioning before about, China importing, exporting more things to the Philippines, what is your take on the Southeast Asia region, triggering a more intra-regional commerce and trade facilities between the countries? Do you think we're going to see an expansion on the imports from the different countries and, relying, moving this 17% export to the US to be a channel to closer countries in Asia?
Well, I mean, given our proximity, that has always been the idea. No? So I guess what's happening right now will force us to think deeper and the ASEAN countries to work together. But the reality is the US is a big market, and China is a big source of efficiently produced goods. So I think it will be easier said than done. But for me, for this type of crisis, I think that also gives good business opportunities. Like my own advocacy is, and I take every opportunity in a webinar to say this, is the Philippine chocolate industry. I don't know if many in the audience would know, but single varietal cacao chocolates using Filipino cacaos are now available globally. And for me, my advocacy is let's use this trade tariff uncertainty to improve our own manufacturing capabilities and export not only to the US, but if we start really taking seriously fine chocolates using world-class cacao products from Paquibato, which is south of the Philippines, then our markets would open up. No, I don't think it will put a dent on GDP growth, but it's a good start.
And a sweet one, right?
Yes, a sweet one at that. Correct.
I think, thank you very much, Alvin. I will, ask Jennifer one question. One of the participants was asking about the lending portfolio on the micro SMEs. We know that across, the Philippines, the micro SMEs are the backbone of the economy in terms of people working, the GDP that they create, and how many direct and indirect business that they trigger in the economy. Can you elaborate more about what are the initiatives? How big is the total portfolio for this type of segment?
Okay, thanks, David. While I will try to skirt away from revealing our total portfolio for that particular segment, what I can say is it was only last year when we created organizationally, we structured ourselves in such a way that we can have a very focused attention on this particular segment. It used to be lending is lending, and it's all lumped together with the big corporates, the multinationals, and of course, human nature will always say, "I'll do the big ones," because it's the same amount of effort and yielding a higher return. Because of that, because of the way things are, we as an institution created organizationally created a segment that would concentrate on what the needs are of this particular segment. And what the needs are is, number one, the risk appetite is customizable, meaning it depends on the industry, it depends on the past 3 years, how they have performed. If they cannot provide full collateral, then again, the credit stance is a little bit more relaxed. Information, the loan application is now in with the BSP stand on a singular application form. All these efforts are enjoined and put together to ensure that this particular segment is not neglected. And because of that, we've seen a growth in our loan portfolio. And again, I will not answer how big our portfolio is, but just to say the direction of the bank is really to look at this growth potential of the small and medium-sized enterprise. I've also seen, if I may, David, I've seen another question in the question box that asks about how are overseas remittances from overseas Filipino can affect, if at all, will affect the negative impact of the potential tariff rate increase. touch on that topic is that foreign remittance to the Philippines can really help mitigate the negative impact of the new tariffs by providing a crucial source of foreign exchange. And the thing is, the influx of foreign exchange funding coming from our OFW or migrant workers are actually higher than the foreign exchange generated from exports of the Philippines. And having said that, that is another area that we're taking a very close look at, is to try to make it very easy for our Filipino immigrants or migrant workers to be able to remit funds. There are a lot of, again, there's a lot of initiative from the government to make it faster, safer, and more united in terms of technology and the ability to safeguard. The truth of the matter, there's still a lot of underground remittance organization working, and that is something that we're trying to address. We want to take everything above the line to make sure that nothing gets lost. Everything is regulated, and just to make sure that it's faster, easier, and safer for all involved.
That's what customers are demanding nowadays, right? With mobile banking, I think we can all agree that our customers are demanding these services, and I'm glad to hear that the efforts from PNB to make sure that their diaspora it's having all the services they demand. Unfortunately, Alvin, I left to monitor the latest development by the Central Bank of the Philippines. It was great to meet you all, and I hope you has learned as much as I did during the session. Thank you very much, Jenny, for